Hi and welcome to Swissquote's Daily Market Talk. It's Friday, November 29th. The French politics sit at the headlines as Americans are off enjoying their turkey dinner and Black Friday shopping. The inflation numbers from Europe to Japan shape the December central bank expectations, while crude oil traders lack direction on news that OPEC Plus will delay its latest decision announcement to give itself some time to decide whether it is not a good idea to extend these production curbs deep into next year. But first, if there was one sector that was kind of thankful yesterday, it was the chips. Because the chip makers around the world felt the relief of a rumor suggesting that the sales curbs to China could be less severe than previously expected from the US administration. But the news didn't necessarily translate it into a strong rally because ASML, for example, which is Europe's biggest chip equipment maker, that actually predicted a 30% fall to its Chinese revenue next year, while it closed yesterday's trading session 0.22% lower, while Tokyo Electron, which was up by more than 6% yesterday, couldn't extend gains at today's trading session in Tokyo. Now, with US post for the Thanksgiving break, France was at the heart of the attention at yesterday's trading session. The political drama there only got worse as Michel Barnier actually gave concessions to Marine Le Pen, who only asked more of them. Concretely, Michel Barnier actually dropped his plans to increase taxes on electricity, but Le Pen's party also wants him to drop the plans to reduce drug reimbursement, help small and medium French companies compete better, and also index pensions on inflation starting from January 1st next year. So obviously these demands are very nice and they have actually the merit to please the French people, the French voters who, as everyone else, are dealing with inflation and a cost of living crisis right now, but they cost money. And the growing French deficit doesn't necessarily allow the French government to spend all that additional money to please Le Pen and her voters. Because in numbers, the country's debt to GDP stands near 5.5% today, and it must be brought down to below the European Union's 3% target. And pushing for spending the money that you don't have doesn't necessarily bode well with investors, except if you are named after the US, of course. Because remember, Liz Truss wanted to offer the Brits significant tax cuts 2 years ago, and all she got was a mini financial crisis. So this is pretty much what we sense right now from the market reaction to Le Pen's threats that she would actually vote Barnier's government down if he doesn't give Le Pen and her party what they want. So the French 10-year yield eased yesterday. Well, that was good news, but it is after reaching the same levels than the Greek bond yields. Note that Greece has the highest borrowing costs in Europe. So it's not necessarily a good point to reach. While CAC 40 was in a better mood, but the political uncertainties of France will certainly keep volatility quite high across the French-denominated assets into next year until the shenanigans are over. For the euro, we don't yet see a major impact of these political shenanigans of France on prices, but the French touch is not necessarily a positive one into the end of this year. The euro dollar actually swung between gains and losses at yesterday's trading session, caught between mixed inflation data from Spain and Germany, because inflation in Spain ticked higher from 1.8 to 2.4% in November, while price pressures in Germany came in softer than expected by analysts thanks to softer food prices. So this divergence in the bloc's largest economies left traders uncertain about the European Central Bank's next policy moves. This morning, the Eurozone's aggregate inflation data will come in a little after the release of French and Italian CPI updates and is expected to print an uptick in price pressures in November. So the thinking goes, a softer than expected read will certainly keep the European Central Bank doves in charge of the market and cap the euro appetite limited into the 106 psychological resistance level. While a stronger than expected CPI number from the Eurozone should encourage the Euro bulls to push for a further recovery, but in both cases, note that the Euro dollar will remain in a bearish trend below the 106.72 level, which is the major 38.2% Fibonacci retracement on September to November sell-off. Speaking of inflation in Tokyo, I'm not saying Japan, I'm saying Tokyo, came in stronger than expected by analysts in November. Industrial production in Japan advanced 3%. That's almost the double of what we saw a month earlier, but lower than expected by analysts, while retail sales in Japan grew sensibly softer than expected as well. But all traders could see was the inflation number from Tokyo that backed the growing expectation that the Bank of Japan could hike its rates in the December meeting. As such, the rise of the hawkish BOJ expectations shortly pushed the dollar-yen below the 150 mark. Now, I believe that a sustainable move below this level is, well, possible if the Bank of Japan goes ahead and hikes its interest rates in its December 1890 meeting. Now, in the energy space, there is some hesitation about what to do around the $68 to $69 per barrel level for the US crude and around the $72 per barrel level for Brent crude. Because the latest news suggests that OPEC Plus countries will delay their decision time from Sunday to December 5th because it appears that the cartel members need more time to discuss about what to do about their plans to restore production. At this point in time, it is pretty much clear to everyone that extending the production cuts deep into next year, well, is the only viable option to prevent boosting the supply glut in global markets and eventually keep the downside pressure in oil prices limited at a time of easing geopolitical tensions in the Middle East that doesn't give support anymore. In gold, everybody who is interested in gold prices know that one of the major reasons why we saw these gold prices rally so hard and so aggressively over past years is the central bank demand. So the People's Bank of China was obviously one of the biggest buyers of gold, as the shaky relations with the US and the fact that the Russian central bank saw its own US Treasury holdings frozen by the US at the start of the Ukrainian war actually gave and continues giving some good incentive to the Chinese authorities to get themselves less reliant to US Treasuries and more exposed to gold. But it's not only China, mind you, because other central banks around the world are also increasing their exposure to the yellow metal, especially from the Eastern European countries, to diversify their geopolitical risks away. So Poland, for example, was the biggest buyer of gold in the second quarter of this year, according to World Gold Council, while doubling its gold stockpiles is reportedly one of the Czech Republic's central bank's major ambitions for the next 3 years. And the central bank already multiplied its gold reserves by 5 since its new governor took office in 2022. Now, the fact that the yellow metal resists a strong dollar and rising US yields is obviously a good sign that demand in gold remains relatively strong. But when I start hearing the big fat targets like Goldman's $3,000 per ounce prediction for next year, for example, I also start questioning whether the rally hasn't gone a bit too far. So this is all for this week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.